Hi, guys, and welcome to the debut episode of WTW, which is the weekly trading wrap up. My name is Harry, and I will be hosting these episodes as the weeks go by. Um, Basically, the goal is to look at what happened during the week in trading and in the markets and to parse it out through the lens of a professional trader. What we look at, what we should ignore, and what we should concentrate on, and how to come up with trade ideas based on this, and maybe alter our view as well. So, this is the goal of this podcast. My name is Harry, and just let me talk to you a little bit about myself and my background. I've been a professional trader since 2005, a senior trader since 2006 at National Bank Financial, and I decided to go on my own at around the end of 2014 and 2015 and trade for a living. Um, I've been doing this for almost, 20 years now, and I just wanted to say that sometimes trading, like for the retail trader and for the professional trader, there are big differences. And we have to be aware of this if we are to be successful. So I'm just going to give you the perspective of how it is to trade as a professional trader, at least the way I trade, and then to see how things go from there. So why don't we get started? So first, as a trader and looking into the week, I will first have a macro framework about what I think the market is going to do in the next 3 to 6 months. And the reason I do this is because, most traders don't do that. They just look at the charts and they trade accordingly. But I like to have a macro framework about where the market is going because I want to have as much on my side as possible. I want to have tailwind in my on my back and in my sales, so I have all the odds in my favor. It's another way of gaining a little bit of an edge, because if you know where the market is going, that's just one extra arrow in your quiver, one extra bonus that you can rely on. So for me, the most important thing in the beginning is to have a macro framework. So here we're looking at the S&P 500, which is the general market. Okay, I decided to get bullish around October of 2023. Reluctantly bullish because I was generally bearish going into it, and I decided to change into a bullish mode because I was expecting a Santa Claus rally up until the end of the year, and we got a Santa Claus rally. But I turned maximum bullish in December of 2023 because of Jerome Powell, the Fed chairman. He decided to go full dovish. Okay, he decided instead of talking for the whole year in 2023, he was talking very tough, very hawkish about how he's going to keep rates high forever, for longer, higher for longer, all that kind of stuff. But at the end of 2023 in December, he said, I'm thinking of cutting right now. We've retained our goals, and we're going to start cutting in the new year. That was a complete 180. So once this happened, you wanted to be bullish. Okay? So, and as you can see, good things happen when the Fed cuts rates. This is a series of higher highs and higher lows. It's like almost a perfect bull market. Okay, so as we go forward and we look at the trading week, we will be comparing it to our macro framework. Okay, and if our macro framework is positive, then we are going to stay bullish. Okay, that's as simple as that. And if it gets violated somehow, then we will think about turning neutral or even outright bearish. But for now, what is the macro framework? So I'll just go right here into this PowerPoint thing, and the macro backdrop is as of November the 18th. Okay, so what do I look for, macro speaking, in order to get bullish or bearish? So the reasons to stay bullish now, one is that GDP is holding up between 2 and 3%. As long as GDP is holding up, you have no reason to be bearish. I don't care what all these perma bears say. If the market, or the economy, I should say, not the market, if the economy is chugging along at 2 to 3%, which is not great, but at least it's not falling apart. It's just meh. It's an average GDP. As long as it's going up, and over 3% is even better, but as long as it's going up 2 to 3%, there is no reason to stay bearish. That's the first point. Second point, jobs are holding up, as are initial and continuing claims. Okay, jobs are holding up is another sign. If jobs are not capitulating, then we're not in a recession, and we're not going to have a recession. Jobs are not great. We didn't have a great jobs report. I mean, last time we should ignore the previous one because it was due to the hurricane. That was a little bit off. But as long as jobs are holding up, there should be no problem. And initial and continuing claims are falling. It means they're not, if you see a huge rise in initial claims and continuing claims, people are, filing for unemployment, and that's a bad sign, but they're not. However, this is just a lagging indicator. Okay, this is just confirming to us what we suspected months ago. Months ago, we were bullish. So this is just telling us that we should stay bullish and that we were correct in being bullish. Okay, so as long as GDP and jobs are holding up, that's the reason to stay bullish. And the third, and this is the key thing in the market right now, the narrative is yields. Inflation is falling and yields are low. Even though the US 10-year yield has rebounded as of late, we're still in a downtrend. And let's just look at that for a second here. We'll put the US 10-year. As you can see, the US 10-year is on a downtrend. Yes, it's very choppy, but it's on a downtrend. It's currently at 4.41%. But right here in September is when all these great traders came out and started saying that, inflation is going to come back and we should be very wary of huge government deficits because that will explode the deficit. It'll explode inflation. And therefore, in order for investors in bonds to be made whole, they have to take into consideration inflation, so the yields will go up. So the US 10-year government bond is the benchmark. We always look at that. That's what the market looks at. It's the standard. As you can see, in 1 month's time, yields went from 3.6 to 4.4, almost a 1% increase in a month. That is huge. Okay, that is just huge. But it's overdone. It's getting to the point where if you look at a little bit more of the technicals here, this is the RSI, Relative Strength Index, and the MACD. Okay, as you can see, it's getting very overbought. And every time it has done that in the past, it has fallen over after. You see it gets overbought here, it has fallen overbought, it gets falling down. You shouldn't just look at technicals like this. These are just lagging indicators as well, but it's just giving you a hint that maybe this might be slowing down. Okay, because right now inflation has fallen. Even though it's sticky, we're still down, and it doesn't look like it's going to pick up. In my view, this is just a personal view. I don't think inflation is going to pick up at all. Inflation really picks up if we have a supremely strong economy, which we don't. We just have a meh economy. And if the Fed or the government decide to print another $6, $7, $8, $9, $10 trillion like they did during COVID. I mean, during COVID, like if we go back, you can just see right here, after they printed the money at the bottom of COVID, the market just rips. This is just fuel for the market. We're not going to get this unless we get another bout of money printing. So I'm not really scared about inflation going up, and I'm not really scared about yields continuing to rise, because if this happens, if it goes to 5-6%, then we're in deep trouble. The market is probably going to tank. But this is the only thing that is inconsistent with our bullish thesis. Rising yields are not consistent with a bullish market. So one out of our points is not bullish. It's bearish. However, if you think it's reached a limit, it's a series of lower highs here, or stuck in a range, and it's probably going to roll over and go down. That is very bullish for the market, and that is what I foresee going forward. So let's go back to our macro reasons here to stay bullish. Fourth is credit spreads. Credit spreads are low. The triple B spread is like the lowest level of investment grade bonds, corporate bonds, versus the U.S. Treasury, which is the safest bond ever. So we're looking at investment grade bonds at the low end versus the Treasury. And we want to see what the spread is. If the spreads are widening, that means we should be scared. But what do we see? Well, let's see here. Let's pull up. Let's see what the BBB spread is. BBB spread. I like to look at the Fed database. It's the Federal Reserve. So look at the spreads here. It's at extremely low levels. Okay, this is going back, if you go back maximum, we go back to 1998, you can see that spreads are very low. They go up in panic in 2020, 2008 crash, 2000, spreads are going up. Okay, in fact, before 2000, you had a warning. Okay, so you had warnings here before the recession actually hit, and here we don't even have that. You can go down the 1-year chart here, and you can see they're going down, maybe a little bit up, but the general downtrend. Okay, so this is telling us that we shouldn't be worried about any imminent recession coming. Okay, those are the credit spreads. It's another macro thing we should look at. There's no panic here. If you look at the CCC with a junk bond spread, it's the same thing. I mean, we can go, okay, let's go look at the CCC instead, which is the junk bonds. Look, they're going even lower. This is risk on if I've ever seen it. Look at junk. Everybody, if you're buying junk bonds and the yield is extremely low, even historically speaking, I mean, you're still at a very low level. Not super low like it was here in 2006 during the crazy times in 7, but it's still very low and falling. This is the key. Falling. The trend is down, which means there's no panic. There's no panic in the market. So another reason to stay bullish. And another thing is the VIX. The VIX is the volatility index. It tells you the fear index. It tells you whether there's panic or not in the market. So if we look at the VIX here, anything below 20 is bullish. Even 25, it starts getting crazy, but anything below 20 is extremely bullish. It means you should just stay long. Okay, we see no panic and they're actually going down. And look, people say that if we get a VIX at 15 or 13 for a long time, then it has to spike up again. And if it spikes up, it's very bad for the market. Well, look, here we can have a year of the VIX at 15 and nothing's happening. Even the little spike here in 2024 was quickly faded. Okay, this panic right here, which is very strange. Okay, this is what was it? August 5th, during the Japanese carry trade wind off. Let's see here, SPY. It was here, this area. Look, the market fell from a high of 564 on SPY all the way down to the August 5th low. Everything was in a panic here. We had the CNN Fear and Greed Index at extreme fear. Everybody was scared, and the market only dropped what? Maybe 10%. This is a normal drop. But look at the VIX. The VIX spiked to 65. It didn't even do that in 2020 during the pandemic. Oh, we're going 2023. Look at 2020. It's at pandemic levels. It went to pandemic levels, 65. The pandemic was 83. And that's when the entire sectors of the economy were shut down. Factories were shut down. In effect, it's like our factories were bombed out in a war and the VIX went to 80. Here, just a small unwind, 75. That's the panic that you see in this market. This tells me that this bull market is hated. People are reluctantly long. They have one foot out the door. Any small thing and they're panicking to sell. Look at the volume at the low here. It was a gap down from Monday. I remember that day well. From the weekend on Monday, this was huge. Huge. People were scared. Extreme fear at just a 10% drop. This just goes to show you that people have one foot out the door. So this market is extremely bullish when you have this kind of exaggerated reaction on a okay story. It shouldn't garner this much fear in terms of the VIX, which was this spike right here. This is just ridiculous. So here you can tell Anything under 25, be long. That's the fix. The M2 money supply, another reason to stay bullish, the M2 money supply is increasing. If money is coming, I mean, this is just a relatively broad level of money in the system. Okay, it's not the only thing, it's not the only form of liquidity, but if the M2 money supply is increasing, then the market's not in trouble. Okay, let's see exactly what I mean here. Yeah, I already have it loaded up here. This is the M2 money supply, okay, which measures bank deposits and money in circulation. So base money, not pure base money, but currency and base money. So here, if you look at the past year, okay, look, it's been increasing. In fact, since October 2023, when we turned bullish, it's been increasing. It's this is very supportive of the market. Liquidity is coming in. But as you can see here, in 2022, when we had a crash, it was actually decreasing. Money was being taken out of the system. Powell was increasing interest rates. So with money out of the system, it's bad for the market. Now it's good for the market because money is being put into the system. And that money is finding its way into stocks. Okay. So you have M2 money supply increasing. You have the Fed balance sheet is falling, which is not good. That's bearish because that means the Fed is reducing its holdings. However, it's not. It's another bearish item. I shouldn't say only. It's the second one. So, but that's not the end all and be all. It's just one small thing of the Fed decreasing its money. It's just runoff. It's just when bonds mature, they're just not buying them back. It's just letting it run off. So I'll show you what that means here. Let's go here. Fed balance sheet. Total assets of the Fed. See, they're going down. But very, very small and still at very high levels. Okay, and you can see it's not it's just runoff. Okay, I don't think Powell is going to change this because I mean the market's bullish and he can just run. You know, he can just continue with a runoff. He doesn't have to. If he were to go up, that means he's doing QE, and there's no reason to do QE right now. QE is done only when there's a problem. So the Fed balance sheet is down. LEIs are leading economic indicators. They're bottoming. The ISM manufacturing index is one of them, and the ISM services index is another. Okay, so let's look at these PMIs, the ISM manufacturing and services. Services is more important, although they're both important, but services is a bigger chunk of the economy. So if that is performing well, the overall economy will no doubt perform well. So let's see what happens with the services PMI. We have it here, yes. So this is the ISM services PMI. Anything above 50 means the economy is expanding and services are expanding. And anything below 50 means they're contracting. As you can see, every month this survey comes out. And it's very detailed. I can go into it. It's not important here. All that you need to know is that it's increasing and above 50. Increasing month to month means that the services sector of the economy is expanding. That's certainly not bearish. It's a bullish thing. Now, we have services here, but let's look at the manufacturing index. Okay, so look at the contrast here. While services was above 50 and expanding, the manufacturing sector in the States has been contracting under 50, except here was an anomaly, but we can go farther. We go down 3 years. You can see that it's below 50 2023. Actually, it's below 50 since October 2022. It's been contracting for a year and a half, and going lower, which is not a good sign. You don't want to see that contracting faster. Okay, let's go back to 1 year. So it's contracting faster. This is not good. However, historically, these are very, very low levels. 45, I think it went down to 40 or 42 during the Great Financial Crisis. So we're talking about very low levels. Anything that will improve the economy and improves manufacturing, maybe Trump does something and this goes up, this is very, very, it'll turn bullish. But we saw that the services, let's see, Oh, let's see here. Services was increasing, and that's more dominant. So even though we have manufacturing down and it's been down for a long time, services has been doing very, very well. So that is helping the economy go up. And it's being reflected in the GDP figures. So we know that leading indicators like this, there are other leading indicators that we can look at, but this is the most important one. And the others will show the same thing, that the economy is doing well. It's not doing terrible. The yield curve. Everybody's talking about the yield curve. The yield curve has flattened out, and after being inverted since July of 2022, it's actually positive right now. So this is a very rare and unprecedented condition. So let's look at what I mean here. The yield curve. Okay. And the yield curve is usually the US 10-year minus the US 2-year yields. Okay. 10-year government bonds minus 2-year government bonds. 10-year minus US 2-year. Okay. Let's go back here and see. So this is, I put a line here delineating the zero level. This is when they're flat, okay? Anything above that, it means that the 10-year yield is higher than the 2-year yield. This is what it should be, okay? As you go down the yield curve in terms of maturity, the yield should be higher and higher in a normal expanding economy, okay? When it inverts, people say there's going to be a recession. Actually, when it inverts and goes back positive is when the recession is probably going to start in, I don't know, they say 6 months to 24 months. It's very, very nebulous. As you can see, going back, let's go into a weekly chart and go back even further. You see, every time it goes down and inverts, we have a recession here. This is 1990. We had the recession in 91. Here, when it goes negative, this is the year 2000, the big crash. Okay. Again, in 2006, 2007, it went negative, then boom, positive again. Then we had the crash. Yields going up like this is the Fed dropping rates massively on the short end. This is what this spike means. So it went, I don't know, maybe rates were 5-6% here, and by the time we get to like 2010, 2011, it's at zero. Here's probably at zero much faster. So we expected the same. Look how long it lasted, a year and a half. It's very rare. See, it doesn't last that long. It lasts maybe a year. This is the longest one ever. It's a very unique situation that we shut down the economy in 2020. And again, positive. Now, does that mean the Fed is going to drop rates all the way to zero? Who knows? But we can say that if past this prologue, we can say that we should be on recession watch right now. Okay. Should we? I don't know. So far, I see nothing else. I see no recession so far. Another reason is the technicals. Now, we've talked about the fundamental reasons, and now we're going to talk about the previous 9 reasons were fundamental in nature, and that built our macro bullish framework and why we should stay bullish. And now these next 2 are technicals. So these are the technicals on the charts are bullish. As we mentioned before, we have a series of higher highs and higher lows. Let's go back to SPY. And let's go back to the daily chart. See, series of higher lows and higher highs. It's very clear. A 2-year-old can see that this is a bullish chart. We don't have to go much more into it. And another element I want to bring in is the sentiment. Sentiment is at neutral, and which is good. We are climbing a wall of worry. This is what you want to see. As I mentioned before, every time the market falls 2 to 5%, people start panicking and sell. They have one. Well, let's correct this. It's 1 foot. Oops. 1 foot out the door already. Let's save it. Okay, so basically what I was trying to say before and mentioned in point number 11 is that every time the market falls a little bit, people panic and want to get out. Okay, we can see it through the sentiment indicator, and the sentiment indicator that I like to look at, I mean, you can look at a lot of them, but I like the CNN Fear and Greed Index. Okay, and here we see it's at greed, but before, if you look at SPY here, here during this crash, it went all the way to extreme fear. So it was a good time to buy. It's a contrary indicator. You should buy here. And now we're at greed. After Friday's close, we had a very good day, so now we're at greed. Okay. But this index, every time we see a drop, even at 2 here, even this small drop, this was enough to bring it from slightly greed to neutral and almost at fear. It was up to here, literally like at 47. Okay, so even a small drop like this was enough to bring it to a level where it fuels the next up leg. So this is where we're at. We're still bullish technically and still bullish fundamentally. So this is what I mean by having a macro backdrop that is bullish and the reasons to stay bullish. Okay, so we will be looking at, every week we will be looking at what happened during the week, and we will base everything on this macro backdrop. Did it really change our macro backdrop or not? Okay, so having said that, let's go and discuss what happened this week, okay, which is basically these green candles starting here. Okay, this is what happened during, let's put an arrow right here, starting on this arrow right there. So 1, 2, 3, 4, 5 days, very bullish. Okay, so what happened Monday? Monday we had a number of things. We had the big news of the day was that Russia is getting a little pissed off because, well, they don't like the fact that Biden allowed Ukraine to use long-range missiles, in Russian territory. This escalated the war. This has a potential of escalating the war and bringing the U.S. into it. So Putin also, at this point, limited enriched uranium shipments to the West, because if you know that little bit about the uranium market, a lot of the uranium processing and discovery, well, the discovery is done, a lot of it is in Kazakhstan, and which is a Russian territory, technically, air quotes, because it's its own country, but Russia controls it. And they control a lot of the supply, and they control a lot of the enrichment from U308 into F6, which is a next step into enriching fuel so they can put it into a nuclear reactor, so they can, create fuel rods to put into nuclear reactors for generating electricity, clean, carbon-free electricity. So what happened to uranium stocks at this point? Well, let's see. On Monday, they ripped. They were trending on here, and then they just ripped. This is the uranium index. Okay, but if you look carefully, they're still stuck in a range. So does this change? How does this change our view on uranium stocks? If you don't know, I was very bullish uranium stocks. But for now, my view is bullish, but I'm not crazy bullish because we're still stuck in this range and nothing big has really happened. So I'm going to view it as a trade. If you're already long uranium stocks, which I was, I sold a bit into these spikes. So that's how I viewed it, okay? There are a number of trades you can use here. A meme stock for uranium is Oklo, which is owned by Sam Altman. They love it. Okay, you see it's still stuck in this range. Yeah, it could break out, it can go higher, it looks good. So the uranium sector still looks good, but it's not as good as it was back in 2018 when uranium was trading at $25 a pound. So, do we make a trade on uranium now? No. I think it's the risk reward isn't there. If you're already long, I took some profits. Okay. And based on this Russia news, we know that gold ripped as well. Look, these are the 5 days of gold. Gold was going down based on the Stanley Druckenmiller bet that rates are going to keep going up because of inflation. So gold got hammered. And if you knew anything about gold and what drove this move, it wasn't really rates. It was really central banks buying in the future. So this was an opportunity to buy. This is just a normal 10% correction in a general uptrend. So I'm still bullish gold. You should have been buying here. But I just stayed long, and I'm still long. Gold miners are different. Gold miners are not as good as gold because going back, they haven't even reached the highs of 2020, let alone the highs of 2011. Like if you look at the monthly chart, you can see the miners in the halcyon days of 2010, 2011. You know, the mining index reached 66. Okay, we're at not even over 40. We haven't even breached the highs of the pandemic high there. But if it does break this level here, it'll probably go to the highs, which I suspect will happen in the coming weeks and months. Okay, so this might be a good time to accumulate for a longer term. Okay, that's the way I look at it. So what else happened on Monday? Well, we heard that Spirit Air filed for bankruptcy. If you know me, you know that I hate airlines. They're terrible. In fact, this just confirms to me that how terrible they are. And one of the shorts that I was working on is Boeing. This could be a good short. I was shorting around here, and I took some profits when it broke down here. Although I'm still short. It's still on a downtrend. It's still a bad chart. Look at this. Still a bad chart, and I don't think it's going to have any legs. This rebound, I don't think will have any legs, but could be wrong. I will cover. As long as I covered a little bit here, I booked some profits. I'm happy with this short. So always look to airlines, in my view. Always, not always, but generally you should look to airlines to short when nothing is happening. But generally speaking, if we go back to SPY, okay, and we look at this one day, I'm going to go to the 15-minute chart to show you what happened on Monday, okay? Where is Monday? This is Friday, okay. This is Monday, okay. Monday, 10 o'clock is right here, okay. So what happened initially? You had the SPY going down, excuse me. Initially, if you can see it here, you can't really make it out. It went down very little. So that's super bullish. And if you can see, I was tweeting on Monday that you should be buying this because this is a retail trader would look at this Russia thing and think, oh, it's going to be a bear market. We're going to get hit because Russia is going to escalate the war. We're getting into the war. No. If you have such a small reaction, let's see if I can blow it up a bit more. I can blow it up a bit more here. Here you had a small reaction going down on Monday, 9:30, literally here. It went from 586 to 585. That's nothing if you think World War III is going to start. So you should be buying it. You should be fading every drop. In other words, when you see these Russia escalating war stories and the market drops, you should be buying it, period, because nothing fundamentally has changed, okay? It will not change the macro output. Again, we go back to the macro. Will it change? Will yields go up? Okay, again, if we go back to the macro, will it change GDP? Probably not. Jobs hold? No, jobs are holding up. Is inflation going to increase? No, that's their problem. It's probably going to keep going down. Credit spreads? No, the credit spreads stayed the same. Nothing happened. VIX, what happened to VIX? Nothing. If you look at it, where is Monday here? Thursday, Tuesday. What was it? Monday, Monday, VIX, down. A little spike up to 17, wow. And then down means that the market recovered in VIX and nothing happened. This spike again. Well, we'll get to that. That's Tuesday. So on Monday, nothing big really happened. And one more thing. Another reason to not be bearish when this was announced. Again, we're in the 15-minute chart. Go back to the day. Is that, oops, where are we here? Oh, here we are. Okay, we'll go back to the day. Another thing that was happening here is that Bitcoin was ripping. Monday, Bitcoin was up. If Bitcoin is up and the market is down, that's, you know, the market is not going to stay down for long, because Bitcoin will get crushed first, get crushed faster than the market. So you should, when you saw Bitcoin still holding and the market down, you should be buying. Now, let's move on to Tuesday. Tuesday was the same thing. On Tuesday, if you look, Russia escalated the war. Okay. I mean, Ukraine escalated the war, firing even more missiles into Russia. And what happened to the market? Same thing. 15-minute chart. Same thing. Market opens down on Tuesday from 588. This was actually a bigger reaction. Where is it? Tuesday. All the way down to 585. Yeah, about the same. Fade it. Buy it. Because what happened on Tuesday with Bitcoin? Let's go to the 1 hour chart. Monday. Tuesday. This is Tuesday. Monday. And then, no, this is Tuesday. Bitcoin ripped. And went down a little bit, but that's later on. This is Tuesday. Up. Bitcoin goes up. So, nothing to fear when Bitcoin is ripping. Okay. Let's go back to the day. So on Tuesday, you had another thing, another Russia scare, carbon copy of Monday, do nothing because it doesn't change our macro backdrop. Yields didn't go anywhere. Credit spreads didn't go anywhere. If Russia was really, if there was a threat of World War III, like a real one, you would see TLT, which is the 30-year bond, rip, go up. You're nothing. These are the daily chart. Barely moved. Okay. I think it's going to go up for other reasons, because I think yields are going to fall and the inflation scare is going to reverse. But when every other macro move is not confirming the Russia World War III narrative, then forget it. Okay, don't react to it. That's the point. Don't react to it. There's nothing to do here. Stay long, stay strong. Okay. On Tuesday, building permits came out, which you should be looking at building permits. They were 1.41 million versus 1.43 million, so they went down a bit, but it wasn't that much. They're still holding strong. So building permits is a leading indicator because it would lead to housing starts down the line in 3 to 6 months. So that you should be looking at it. And you should look at home builders because of it. Home builders weren't affected. They're going up. This is the XH, it's a home builders index. So you know that the economy is still doing strong. It confirms our bullish narrative. Okay. So moving on to Wednesday. What happened on Wednesday? Well, everybody was waiting for Wednesday because that was when NVIDIA was going to give its big after hours earnings. What happened? NVIDIA on Wednesday. Here. This candle right there. Nothing. I've never seen this. Usually NVIDIA rips or tanks, but usually rips. In fact, nothing really happened. So everybody that bought calls in anticipation of the earnings, which by the way, they beat. They beat by 8% and 5%. Nothing, but just the market was like, meh. It's not crazy. We're not in super bullish mode because if this was like back in early 2024, we'd get these kind of rips in NVIDIA, like overnight, we'll get gap ups after earnings, like we saw here, boom. and you see that here? No, it actually went down here. But you would see gap ups in earnings if it was early 20, like here, look, because that was the bullish narrative. So I'm still bullish NVIDIA. I think it's going to go up with the rest of the market going forward, but it's just telling you that it's neither, there's no fear yet. Like if we really had a bad market, if we're in a bad market environment, even if they beat by this little, it would be down big. And we're not getting that. So this is pretty good now. It confirms our outlook. Wednesday, the big, quote unquote, the big news on NVIDIA, it just shows that market is still good. Okay. So what happened on Thursday? Well, Thursday is the continuation. Well, the whole week is Bitcoin. Bitcoin is the story of the week. Okay. Look at this classic breakout from a high, goes up here and consolidates, which is exactly what you want to see, a high tight flag, and then boom, breaks out to the top. It'll continue. Okay. I was expecting it to go to the 100,000 level. I'm long Bitcoin, but through proxies. I don't actually have Bitcoin, but I have some Bitcoin, a Bitcoin miner. I have Mara, which is not that great. Okay, it still went up. Okay, I'm long at 18, and I sold like half. I sold half my Bitcoin exposure. I also had Bito, which is not a great one too, and I had still ripped. I was long at 20 here, and it ripped. Pretty good, not great. But the Bitcoin stock, I'm stupid. In the future, I'm not buying any other Bitcoin proxy except MicroStrategy. This one ripped much higher than Bitcoin. I mean, you tell me this company holds Bitcoin and it rips much higher than Bitcoin in terms of percentage returns. I don't get it, but mental note, I'm not missing this again. If I ever want to play Bitcoin again, I'm going to play MicroStrategy. This is what I learned. So as a trader, this is what you look for. You look at things that are that you can learn from, and if the situation ever arose again, you're going to pick this one. Okay, and now we're back to Friday. And Friday, the big news was the European and world PMIs. Just like the ISM services PMI that we looked at here and the manufacturing, we got the EU PMIs and UK, which is Great Britain. We got their PMIs, and basically they sucked. They were worse than the States. They both went down. The UK PMI actually fell into contraction, and as did the European PMIs. Remember, under 50 means contraction, over 50 means you're expanding. So Europe officially, the EU officially, I should say, and the UK now, overall went from flat to slightly, they're basically at 50, which is like on the border, doing nothing, and now they're going down. Okay, this is not an inflation narrative. Inflation is not going to rip in these situations. When you have the rest of the world, ROW as we like to call it, when you have the row down, I don't think the States is going to be inflationary. So that is the big take on the market news for the week of November the 18th, 2024. So as a trader, the things that we should look at is, do any of these things that we mentioned, the European PMIs, the Russian invasion, the Bitcoin, gold, yields, this is the big one, US 10-year. Always keep an eye on the US 10-year. I took a position here on TLT. I went long TLT, which is the exact opposite of this, US 10-year. So I went long TLT because I think the near 1% move in the US 10-year in a month is overdone. Okay, I think we're going to start going back up again. I think inflation is going down. I think rates are going to start coming down again in the mid and long end of the curve. So that is the big takeaway for me for this week. I'm really focusing on the rates and inflation. I mean, you can look at inflation, which is the break-evens, the 10-year break-even inflation, right? You can see it did go up, okay, during this past week, but then it's sort of holding and going down, okay? And technically speaking, if you look at this, you have an increasing inflation here, and the RSI is slowing down. That's called negative divergence. It's not a guarantee, it's not perfect, but it fits with the narrative that I have, that the markets are going to go up. We're in a bullish narrative, we're in a bullish phase, and in order for that to happen, we can't have rates going up. They'll probably go down. And I have the technical sort of supporting that bullish thesis with a negative divergence. So that is why I decided to go long TLT. And if you look at my Twitter, look at my Twitter handle here. 1 second. At GR4, where you can just call my name, query my name, Harry Otis, and you'll see I initiate a long position on TLT and the various ways that you can play it. Okay, I like to use options, so that's how I play it with options. So that is the end of our debut episode of WTW, the weekly trading wrap up, and I hope you guys liked it, and I hope you learned a lot, and looking forward to doing more. Thank you very much.